And joining me now for a closer look on what's playing itself out in the market scene is Richard Court from Argon Asset Management. Richard, a pleasure and a good afternoon to you.
Good afternoon.
All right, Richard, not the best start to the week. Keen to get your thoughts here. I was seeing red screens in Europe, but also right here at home.
Yeah, not the most positive start to the week. I think just with both ABSA and Nedbank both reporting this morning, and you've seen some trading statements from smaller and mid-cap businesses that sort of just brings to the fore just the struggles that the South African economy is going through. I mean, these are all things that we're aware of, but it's when you see them coming through in the numbers, whether it be credit loan. Credit loss ratios for the bank, and just increased costs and lower volumes for some of these smaller businesses. It does just remind us that it is tough out there.
We do speak of cyclical markets here. You know, are we speaking of all of us in this cycle, Richard, and that, we should see maybe in the medium to longer term an uptick here, just better volumes on the JSE, better performance from the JSE? Or could we say that the JSE has entered a new range of lows and a new territory altogether?
I think I don't have a crystal ball. I mean, if I did, I'd be living on an island somewhere. But what I can say though is that when things do appear to be darkest and dreariest, so that's normally when good investments are made and future returns are sort of locked in. So when you start looking at the JSE, you have had the market just getting smaller. The amount of volumes being traded has declined over the last couple of years, and yeah, you haven't seen many new listings, many new entrants to the market, and you've seen delistings and companies getting taken out. And on top of that, you've seen the valuations for South African businesses, excluding some of the dual listed and the companies that are listed here but aren't actually South African businesses. Mm-hmm. The valuations of the SAN companies are they screen very low, and sort of implying that there's good prospects for future returns, mainly due to the fact that the amount of pessimism around is so significant.
Looking ahead, also, we are anticipating U.S. inflation data there. I'm wondering if markets are sitting at the edge of their seats anticipating this one. We've had a lot of feedback coming from the Fed. We've also seen quite a bit of data, and I'm wondering if we're going to spend another week looking forward to this.
Yeah, I think the market is completely and utterly fascinated with what the Fed is going to say and what the data that the Fed is speaking to. It just seems so many investment decisions are being based on these macro calls on when the Fed will cut, if they will cut, to what degree, how many cuts will there be by what date and time in the future. It does seem to be all the talk of the town. We're not going to try and outguess the market as to when rate cuts are going to take place. But yes, I mean, everyone's going to be watching the inflation print tomorrow. The Fed has come out and said that they look at what inflation rates are and also what unemployments are. And the market is looking for signs as to when they can expect interest rates to be cut, because that will translate into higher asset prices, which by and large most market participants want.
Also, keen to get your thoughts on the oil price. Richard, we are seeing at around $82 a barrel. It has been a volatile one for oil, and I'm wondering also what your thoughts are on that one. Of course, we have heard of softer Chinese growth and demand, but also OPEC plus countries have also extended supply cuts. They don't seem to be working.
Yeah, look, I mean, again, the oil market is a huge market in the commodity stable. It's there's billions of participants in that driving the price of oil. In the short term, I mean, I can safely say I do not know where it's going to end up. I think in the longer term, though, what we have seen in the oil and gas sector is that for many years there's been a decline in capex spend in terms of looking for and replacing oil reserves. So at some point in time, if we we could get to a point that, this might sound strange given the ESG environment that we're in, but we might find ourselves short of hydrocarbons, and the price of oil and gas being higher than where we are now. But in the short term, I mean, if you've got the Chinese economy that's still growing, or it's trying to grow at about 5%, if that slows down further, that will lead to a reduction in demand for oil and gas, and that has to translate into a lower oil price.
And then to get some company news today, starting off with ABSA, I would say possibly a performance that the bank has called resilient. I'm not so sure if I just compare with peers. Richard, keen to get your thoughts on this one.
Yeah, so yeah, as you mentioned, like ABSA came out this morning. But I think the thing that most people will be focusing on is the fact that credit loss ratios haven't declined, and that the bank sort of seems to be implying that they're going to stay at this sort of level for longer. The business model of the bank, they seem to the earnings improve as interest rates rise, if they rise gradually because of the net interest margin increases. But the counterpoint to that is that higher interest rates makes it tougher for their customer base, for a whole host of reasons, which comes through in a higher credit loss ratio. So yeah, it does seem that ABSA, based on these results, seems to be underperforming their three peers, FirstRand, Nedbank, and Standard. But yeah, they're still, look, I mean, the banks as a whole still seem to be reflective of the sort of challenges that SA Inc. is facing, and they're still on the cheaper side statistically, or quantitatively. They screen quite attractive. So we still actually we're overexposed to the banking sector.
And then before we move on, keen to get your thoughts on Mete moving out of a loss right back into the black, and I think a pretty strong showing for them. It's quite a recovery.
Yeah, so Mete is it's on the smaller side in terms of its market capitalization. I think it's under 3 billion rands. We don't keep that close an eye on it, but it is very interesting that the share price is now lower than the May 2020 lows. I think that's very interesting. And yes, like the market did seem to like the trading update this morning. I think it was up about 12 rand from below 10, so up about 20%. But also reading through the trading statement it's again indicative of the challenges that smaller and mid-sized South African companies are facing, struggling with logistics, having to keep extra stock on hand, because they're worried about supply chains. And then also just with Mete being an OEM, original equipment manufacturer for automotives, globally there is a bit of a trough in that industry at the moment. So Mete, it might seem like they've done well compared to the prior year. It also seems to be an interesting investment proposition.
Well, Richard, I'm keen to get your stock pick in a bit, but first I'd like us to reflect on counters that have found favor with your industry peers.
Looking at Spur Group, I think that, I mean, the results were quite outstanding that they released to us, and also the business, I mean, has been faring very well. They've just added Doppio Zero to the mix. They do also have other great franchises that they own, and so the reason I think is that they've been weathering load shedding and also what we're going through as a country very well. Yeah. And the business still seems to continue to grow. They've added also 12 restaurants as well in the last results, so I think Spur is a good buy for me right now.
I'm going for Sasol. I'm going on the back of interest rates will fall, the global economy will recover, there will be more demand for commodities, the oil price will go up, etc., etc. So it's a normal commodity story, but specifically on Sasol, they heavily geared to global chemical prices, and they are in the doldrums, and hopefully they also pick up, and the share has been hammered. So this is a typical value type of recommendation. Don't put all of your money into it. Don't put widow and orphan money into it, because these shares can go down for longer than what you think. But I think on a 2 to 3 year view, Sasol shows quite good value at this level. I mean, they can, in good times, they can get 40, 50 rand profit a share. And you times that at an 8 or a 9 price earnings, 10 price earnings ratio, it's a lot higher than the current share price.
All right, Richard, keen to get your thoughts on those counters, Spur and Sasol.
All right, so Sasol, yeah, so we share a lot of the points your guest made on Sasol. Also agree with the fact that like chemicals globally is in a bit of a trough, and as that cycle turns, it should be a tailwind for Sasol's profitability and hopefully a re-rating. But we have a small position in Sasol. It is a riskier investment proposition. We think there is some, I wouldn't say low-hanging fruit, but there are some things that the new management team needs to get right, the new CEO needs to get right, and that's to improve the mining operations in the business and yeah, maybe just come to terms with the fact that Sasol is a very carbon-intensive business, and it just needs to plow forward and do the best it can. Just on the other stock pick, I think was Spur.
Yeah.
Spur, it's on the smaller side for us. I think it's about 3 billion rand market cap. So it's we take issue with the lack of liquidity. It sort of keeps us out of that stock, but it does scream very cheaply. I think it's on about a 10% dividend yield, which is very attractive, and it's a nice business model. But you can sort of understand why it's not more highly rated, just given its exposure to the South African consumer and people's concerns about disposable income and possibly rising unemployment.
And with that said, which counter are you going with today?
We're going with something a bit different. We're going with Hammerson, which is the UK and French shopping center owner. It's dual listed. It's a listing on the JSE. They had announced their results, was it 2 weeks back? They've come to the end of a disposal program, which the market at the time wasn't too happy with because it was dilutive. So at the moment, they're out of danger in terms of their balance sheet. Even though the LTV does look a bit high, there is still some refinancing risk. But frankly, with all global property companies, there is refinancing risk because they extended or they took out loans when the interest rates are far lower, and as those loans roll off, you have to refinance them in the current interest rate environment where interest rates are much higher. But we still think Hammerson has got some strings that it can pull. Mainly, it has a very significant exposure to an unlisted property business called Value Retail, which they've disclosed that it is non-core to them. If they are able to dispose of that for anywhere near what they're carrying it for, there will be significant upside in the share price.
Fantastic, Richard. It's been a pleasure hearing from you today. Thank you so much for your time. That was Richard Courts from Argon Asset Management.